Well, hi, everybody. I'm Rick Edelman. Thanks for joining us on this webinar today. I'm really excited about it because rather than just presenting the news, which we typically do on this event, where we're telling you what's going on in the marketplace, in some sense, we're actually creating the news today. We're going to be telling you what advisors and investors are saying today about digital assets. We're going to be releasing the results of a new survey, and I'm really excited that you're here to see the data before anybody else does. And to help us figure all this out and to reveal not only the data, but what the data means, I'm very excited to be bringing on today Paul Price, who is the operating partner of Lionsoul Global, and Matt Higginson, partner and head of global Web3 activities at McKinsey. Matt and Paul join us here on the program. Great to see you both.
Great to see you too.
Good to see you, Rick.
McKinsey is, of course, a household name. Doesn't need a whole lot of explanation about who McKinsey is. Matt rather is the global head of Web3 and leads the financial risk in the Americas with a very deep knowledge in DeFi and tokenization, working with folks across the globe. Paul, you're based in the UK, I believe. Is that right?
Indeed, yes. Yeah.
And Lionsoul is a big name in Europe and not so much here in the US, but Paul's been in this business for decades, about as long as I have, as you can tell from he and I not having much hair, and what we have is both gray. But give us a little more detail, Paul, because I don't think everybody is terribly familiar with who Lionsoul is.
Absolutely. Thanks very much, Rick. So yeah, very quickly, the problem we felt we were solving for in creating Lionsoul, if you take my background, is very traditional asset management, Morgan Stanley experience, Amundi, Pioneer experience, MFS before that. So coming from that traditional background, what you learn is that in creating the opportunity within the marketplace, one has to be very cognizant of buyer behavior and what the advisors need and want for their clients to execute in a great fashion. Problem with the industry we saw was it just created product without reference to that first point. So what we've done at Lionsoul is created an institutional grade asset manager that takes care of all of the needs and wants of advisors and allocators, and then is moving on to the whole process of focusing on the actual products. And those products, using the tokenization or other methodologies, will reflect what advisors will typically see in a portfolio, so they can actually manage the correlation effect and allocation patterns that their clients expect them to be able to do as well. So that's the purpose of what we're trying to do at Lionsoul, and hopefully it's revolutionary.
I think it's going to catch a lot of attention here in the US because of the unique services and products that you're offering. We're going to talk a bit about them today. And of course, Matt, McKinsey needs no real introduction, but I'm going to let you provide one anyway, the scale and scope. You had mentioned to me earlier, and it's right there in the upper left on the page, I'm shocked that McKinsey is nearly 100 years old.
Yep. Nearly as old as we are. Yeah, look, it's McKinsey, the truly the first management consulting firm. We actually created an industry, created a business, closing in on our 100th anniversary. Because of that history and because of the scale we're at, we're proud to say we have 130 offices worldwide in more than 60 countries and over 40,000 colleagues. And perhaps contrary to popular belief, we do recruit widely, over 1,500 higher ed institutions. And of course, the purpose of that is to achieve the same level of diversity in McKinsey that we find in our clients. We're a global partnership. What that means is unusually we can pull in expertise from literally anywhere in the world for any engagement. And that really allows us to bring the best of our global firm to our clients. And we invest nearly $1 billion a year in building capabilities, building knowledge, and frankly, making sure that our consultants continue to learn their craft through their time at the firm. I'll just conclude this by saying, like, we have an unusual dual mission at the firm. Two parts, one focused on clients, one on people. With the clients, our mission is really to make distinctive and lasting and substantial, sustainable improvements in their performance. But we can't do that without also having great people. And so our other mission is to build a great firm that really attracts great people and develops, excites, and ultimately retains those people. And with that, we believe that we can bring the best to our clients.
So what really surprises me is, knowing McKinsey pretty well, and I do a lot of work with McKinsey and with you, Matt, and other members of the McKinsey team. I don't think it would be intuitive to most people that McKinsey would be deep into crypto, let alone having a global head of Web3. So talk about the journey and why McKinsey feels that this subject is worthy of a significant level of attention.
Yeah, look, I'll give you an answer in two parts. One is a very personal journey in that when I joined McKinsey, I joined largely into the banking and payments practice. And very early on, we became aware of the potential of Bitcoin and the underlying blockchain technology to potentially, if not revolutionize, at least challenge the status quo for banking and payments and financial market infrastructure. And of course, we have followed the ups and downs, the roller coaster, if you like, of the sentiment around that thinking. I think the last few years, though, more importantly, we've recognized the benefits that the technology could potentially bring. And I would say that that goes beyond crypto to this broader topic around digital assets. And specifically, when we think about the problems it can solve around efficiency and speed and liquidity, and even getting access to illiquid assets, our sense is that if we continue to partner with our clients, we can continue to push that frontier forward to the point where we think, frankly, this is the path to true digitization in financial market infrastructure. And so it's a crypto story, but it's a bigger digital asset story. And I think we are just beginning on that journey, and we'll see more and more of this coming.
And similarly, Paul, what got you to focus in the digital asset space? I mean, you were a traditionalist, as you've said, like so many others in the crypto space. You come from Main Street, Wall Street. You come from some of the biggest ETF and mutual fund providers in the industry, and now suddenly you're focusing in the crypto space. Talk about your journey down that rabbit hole.
Yeah, no, I think it started more as a personal journey at first, in realizing that what was happening in the digital space, particularly around blockchain and distributed ledger technology, was going to revolutionize the speed at which we were going to be able to transact globally. Naturally, everybody looks to crypto, but I actually felt that it was going to be way beyond that, and that the whole area of tokenization would be a revolutionary moment for our industry. And reacting to that and understanding it after 35 years in the industry, if I wanted to see another 10 years of it, I think I have to know about it and understand it and not be fearful of it. And so that really took me on the journey, then meeting up with the founder of Lionsoul and hearing his vision for how he was willing to look at putting together the infrastructure first and then follow with the product, rather than going with the usual sexy story of let's buy Bitcoin and go on a rip as it goes towards whatever the latest crazy prediction for it will be. I mean, that in essence is an irrelevance. What is more relevant is the democratization of ownership of assets globally through tokenization. And that may be expressed through Ethereum, but Ethereum as a token rather than as a currency. And I think that that's going to really matter on a go-forward basis for all of our clients, and for us to understand that and be aware of it and actually create a safe environment in which we can transact in that space that looks like the traditional world that we've all come from.
And with that in mind, it's really powerful what you just said. I want to make sure we highlight that if you want to remain relevant, you need to understand this technology and its application in the investment management field. Too many people, I find, are too dismissive too quickly. They dismiss it as a fad or a fraud, and they pay it no attention. And so with that in mind, let's delve into the survey results. We surveyed with McKinsey financial advisors across the country. About 300 of them responded to that survey. Matt, tell us a little bit about who these respondents were, because that'll help us level set the nature of the answers they gave us. So we've got some basic data of who they are on the screen. Give us some elaboration on that.
Yeah, sure, indeed. We'll do that, and then let's get into truly what we learned from them. Look, the survey was sent out to all of the DAC-FP membership. And actually, thanks to you, Rick, after one of your podcasts, got a good response, almost 300 respondents. I think when we look at the mix across the financial advisors who responded, most are working for registered independent advisors. You can see around 40%, and a similar sort of number for independent broker dealers. And that's pretty much as you might expect. I think it gives us a sense that it's a pretty representative sample. The other thing is that when we look at the number of clients and their assets being managed, we also think this is pretty representative. So when you look at the US financial advisor market and you look at the results of the survey, here on the survey, we were finding typically 180 to 200 clients each, maybe up to around 200 million AUM per advisor, so $1 million per client, and a focus in this case on high net worth and the high net worth. That's the sort of 10 to 30 million asset range, market segments, which again, I think is a pretty good representative sample of what we would expect if we were to have an even larger survey.
And as we go through this conversation, by the way, I want to remind you that you're welcome to submit your questions. Many of you did when you registered for the event. We're going to tackle as many of your questions as we can. And if something piques your interest or curiosity as we're discussing, there's a Q&A box here on the Zoom link. So just type in your question there. I'll be looking at those throughout the event and bring our conversation with your questions as well. And we're going to start off with my first question. How well do you think, Matt, that this sample of advisors is representative of all advisors across the country? You think this is a pretty fair representation?
Yeah, look, I think in terms of numbers of clients served and the types of clients in the AUM, I think the profile of the respondents does look pretty similar to the national average. I think that we would expect that they're likely skewed in their attitudes towards digital assets because obviously the membership of DAC-FP. And I think that membership is going to push us towards this, understanding that there's going to be an above average interest in digital assets. I think there's also likely to be above average engagement. That's a good thing. But I would say caution a little bit that when we see other US-based financial advisor surveys outside of this digital asset specialized audience, we typically see around maybe 10, 15% of US-based financial advisors who will engage with digital assets.
Yeah, we surveyed all advisors around the country. We invited them to participate. I also promoted it on my podcast. And naturally, the people who listen to my podcast or who are likely to respond to our email request to engage in the survey, you're right. They're probably more favorable or interested or engaged to some degree or other in the context of digital assets. So we should keep that in mind as we look at this data. And one final thing I want to ask as we're about to go into what these advisors said, the 300 who engaged, what are the implications about these survey results? What is it that advisors who and their firms, we have a lot of back office executives, C-suite executives who are watching this webinar as well and gleaning from this data. What are the implications about the answers we're about to reveal as we're thinking about what it means for our practices?
I think, Rick, you teed it up nicely at the beginning, which is like you're almost getting like a sneak preview here. I think we are seeing respondents who are, on the average, probably at a high level of engagement, but also deeper engagement that gives us deeper insights into the types of products that might appeal to investors. What are they actively looking for in their provider, and ultimately more detail in terms of barriers to entry. So our sense is that although this response group may be more bullish than the average, they're also right on point in terms of what are they looking for, what are they dealing with, what are the challenges that they're facing day to day. And I hope that by the time we get to the end of this hour, it gives the audience a real sense about, okay, if we see the train coming here, how do I want to be prepared to get on board? And ultimately, what are my investors going to be looking for? So I think the implication is that these results should be pretty much on point.
Paul, did you have any reaction to this data of who took the survey, who responded to it?
No, I thought actually it was an excellent response rate. I'm not surprised at. Look, I think you have a market that bifurcates around those that are fearful of the the noise that's being created around crypto, as you describe it. Those who just dismiss it as a fad or a fraud, and then those that are actually looking at clients from the perspective of their holistic portfolios. But how do you bring this into the portfolio in a safe and cohesive fashion that helps you to report on it, helps you to integrate it in a portfolio? So I feel that that's as we look at the results and as they go through, I feel that that's kind of the the level of the curiosity that's coming out is how do we actually get to that point where this can be a part of a portfolio where I don't feel it's awkward on the side and that I'm somehow explaining it or treating it differently. And that's the mentality that I think we all need to adopt going into this, because it's a generational effect that we're dealing with. And this generation that's coming through are going to be much more engaged on this, and we need to be engaged as the let's say the senior or the elders of the market at this stage in terms of giving advice as to how we actually integrate this in a safe and compatible way with everything we've done before.
So we're going to show you 4 sets of data here. First, we're going to show you how we're going to segment the respondents for you. Then we're going to show you the appetite that everybody has for investing in specific digital asset products and services. Fourth, we're going to show you the specific features that advisors tell us that they say are important when engaging with digital asset products. And finally, we're going to reveal what everybody says are the major barriers and the triggers. We'll see if what you think in your own head is matched by what your colleagues around the country have told us in this survey. So without any further ado, let's launch right into the very first one. And Matt, here is the level of engagement. You alluded to it earlier, but of the roughly 300 advisors, 85% of them are currently engaged, but a shocking 15% say that they're planning to quit. So talk about this slide because it's fascinating data.
Yeah, sure. So you're right. We've sort of overall tried to divide this into 5 segments, but there's 2 groups out there. The first is this proportion of the financial advisors that are currently engaged with digital assets. And yeah, it's a big proportion of those that responded. There are 3 segments in there. One that we're going to call active engagers. And these are the ones who are actively advising their clients on digital assets. You can see 37%. They're the ones who are saying they are actively talking about digital assets with their clients on a regular basis. We've also got a segment we're going to call passive engagers. They're passive because they are passively advising on digital assets. That is, they can provide access to digital assets if they're asked, but they are not actually pushing the subject with their own investors.
So they'll accommodate the client if asked, but other than that, they're not bringing up the topic first.
Correct. And then this third piece, which is what we call future quitters, which you rightly pointed out, they are currently engaged with digital assets, but actually when the survey was run, they're planning to stop advising on digital assets in the future. And you're right, it's a large proportion. It's 15% of that population that's currently engaged. On the other side, the non-engaged population, if you like, again, we're broken down between what we call future intenders, and that is those who are planning to actively provide access to digital assets in the future, 7%. And then we're calling never engagers, so expecting to never enter the space. And I think going back to this comment on, it shows on the right-hand side that this 85% of the engaged population, it definitely is positively skewed. I mean, this is DAC FP. We'd be surprised if it wasn't. And some of the other surveys, like the Cerulli, the Bitwise, they tend to come out at about this 15%. Now, we can talk a little bit about the implications of this, but my sense at the moment is that even if this was the entirety of the population in the US that was actively advising in digital assets, it still adds up to actually a substantial AUM. And of course, this is just a small subset.
Now, here we are in the holiday season. We actually completed this collection of the survey data back this past summer. So that's 4 months ago. How much do you think the results might have changed from the time people filled out the survey back in July and August to today?
Yeah, so often a good indicator of this and appetite is it tends to roll with the total market cap of crypto. And so you're right, we ran this in July, August. I think total market cap back then was about 1.2 trillion. Today it's just over 1.4 trillion, so 20% higher. And I think, during the time between when we ran this and reporting, we really haven't seen a major shift in products yet in market. But of course, there's been a lot of talk about this possible approval or potential approval of a spot ETF for Bitcoin or Ether or both. And I think that has definitely driven some increase in appetite, increase in inflows in recent weeks.
Take a look at the balance in the data you've just shared between those who are currently engaged but planning to quit, those who are not engaged but planning to start. And when you balance those two numbers, what does that say about the future prospects for the digital asset market?
We spent a lot of time puzzling over this, Rick, and I'll go do a little bit of fuzzy math or a little bit of sleight of hand, but you'll forgive me. I think when you look at the future quitters, if you like, the kind of 1 out of 5, 1 out of 6 of the 85% that are currently engaged, you'd say there's definitely some potential for attrition, right? That's definitely a population that, even though the attitudes may have changed a bit in the last few months, they could be leaving. At the same time, though, look at that 7% of the remainder. So 1/2 of the non-engaged population are what we're going to call future intenders. Now, pause for a moment, because of course we talked about this being the DAC FP survey, and frankly the proportions being skewed. If we go back to the idea that only 15% of the total US investor population being engaged, 85% are not. If 1/2 of that 85% remaining was to then decide, okay, I'm a future intender, suddenly the future engager population looks a lot bigger. And I actually think that's probably closer to the truth. I think there's a bunch of people sitting on the sidelines, likely in that future intenders population. And I think there's a case to be made to say that outlook looks relatively bullish.
And I think the elephant in the room are the pending spot Bitcoin ETFs, which we'll talk about a little bit later, because that I think is going to be moving the needle for an awful lot of folks. But it's that middle number, that 34% I want to ask you about, the folks who are passive engagers. This, I feel, is skewed due to the DEC FP audience, no doubt. I think that if a different array of advisors, if we were to ask them, that number would rise. I think that there's a huge number of advisors, I get this anecdotally just in my travels, of advisors who say what you have said, that I don't talk about it, but if I'm asked, I'll provide it. Because there are now a wide array of crypto-related products that make it easy for the advisor to engage. There are proxy stocks, there are crypto ETFs, there are futures ETFs, there are SMAs in the crypto space, there are qualified IRA custodians. There's a wide variety of ways that advisors can engage, but they aren't at the moment. They're reacting responsively. They're almost acting like the clerk in the shoe store. If you point to a shoe that you want, I'll go get it for you, but I'm not going to give you any advice on the shoe I think you ought to be wearing. What is it going to take? Why is it that so many advisors are behaving that way? And what's it going to take for them to go from passive engagement to active engagement?
So let me throw out a few ideas, and then Paul, I'd love to hear your reflections on this too. I'll give you 2 or 3 thoughts. One is that I think there is still a degree of difficulty in just accessing the digital asset products, and particularly if you're not doing direct, if you're doing indirect and some kind of tracker, these are still relatively rare today and difficult to get access to. I think perhaps even more fundamentally challenging is just low levels of education. And that could be a whole range of different roles and responsibilities. But frankly, people still being concerned about elements of this industry that may well be justified, but really just not understanding it well enough to be able to say with confidence, yep, I can recommend this. And then the third, which is a bit more mundane, which is just around priorities. And frankly, if we believe that these recommendations come with a few single-digit % of a portfolio, that leaves a lot of other things to recommend to your clients other than digital assets. And so I think it's a matter of priorities at this stage, is my sense. Paul, what do you think?
Yeah, I think it's a combination of that. Absolutely, I'd echo that on the priorities. But I think if I was an advisor today, and given those conversations that I've had when I was running the intermediary business as global head of Morgan Stanley's investment management business, I would say the one and most important word that you hear is trust. So trust in you as an asset management firm. And I think actually the digital experience has a long way to go here, because a lot of it is very new. And building that trust is going to be the most important factor. So today, I think that the passive engagement is probably a first step into this. but not to get too adventurous. And it's not helped by an industry that creates products on the basis of, a beta explosion in the price of crypto from time to time, and then dress that up as some sort of alpha creation skill. In my view, what you actually have to do is get it right first on the trust side, and then be judiciously cautious in terms of the types of product that you introduce to these passive engagers. But I think that will accentuate the behavior. I often think back to, in terms of strategies and building strategies, and whether it's at Morgan Stanley or whether it's at Pioneer, one of the biggest ways we built trust and partnership with investment advisors was through working our short duration type products, so that they came in, they trusted us, they saw the whole mechanism worked, they could onboard the client, they get the reporting, and then you had the opportunity to talk about the more active strategies. And I think that's not going to be dissimilar in terms of the strategy here. So I think a lot of what we have from the traditional space will echo into this in terms of how we do it. The problem we have is in some ways is that you have an industry that's been created by the shiny toy approach versus just get boring. That's why we have the gray hairs, and and we're still around in this industry, because we did things safely, and we wanted to work out how we can actually build trust in what we were trying to actually achieve.
Yeah, I've got a bit of a problem with this data, though. I think your answer was really good, Paul, but it gives me a bit of agita. There are advisors who really, and their firms, who fall into two camps: those who can and don't, and those who can't. Those who can't because their compliance won't let them. Their firms have simply not approved the products. So the advisor, regardless of their attitude, is just shut out of the marketplace. That's got to evolve and change, because those compliance teams, those investment committees, the C-suite itself, they're making a big mistake, but that's a whole nother conversation. Let's talk about those who can but aren't, meaning they are only giving the client a crypto product when the client asks for it. That, to me, is an abdication of the advisor's responsibilities as a fiduciary. If you're willing to say yes to the client who asks for it, go ahead and I'll give this to you. Are you doing that merely to placate the client, to appease the client, to avoid having the client get mad at you and leaving? As opposed to acting as a fiduciary, either holding your ground and saying, no, I don't believe in crypto and you shouldn't do it, and here's why. Or if I'm willing to let you do it, it must mean I don't hate it all that much, and maybe I ought to learn more to understand why I'm so passive about it, and get to the point where I'm willing to actively give it to everybody. I'm just wondering, at what point are we going to acknowledge that many advisors are simply not doing their jobs? Do you have any thoughts on that, Paul?
Well, I think I would equate this, if I went back 22 years ago, when we saw alternatives beginning to creep into portfolios. And I suspect the pattern that you're seeing here is not going to be dissimilar, that they began to get approved at home office level or at the allocator head office level, and they didn't get allocated automatically. It was quite a stubborn 4 or 5% at the beginning before it started to accelerate. And I think that there is an element of that, of fear of the conversation, and fear of the reaction to that conversation from your client. And when you heard everything about hedge funds and such before, and there was the big story is always the dramatic blow up. Whereas what you actually and so when you bring these subjects up, then everybody will say, well, they'll name the latest scandal. And I think that's quite pertinent on the digital space. And some of the happenings in the digital space that are totally unrelated to the asset management side of digital would get brought forward as the examples, you will be fearful that they'll be brought forward as examples too. The reality of it is, though, is that the clients are engaging, and today they are probably engaging outside of the advisor network today. And what we need to do is to make a mechanism so that we can, for us, and that's our ambition at Lionsoul, is so that we can be embraced in as that trusted partner that shows that bridge, that it teaches you about how you can create a secure wallet for your client that's better being in one of these more expansive wallets at one of these exchanges. how you can actually trade efficiently, how you can think about yield, how you can think about tokenization in terms of the real asset space. So I think the revolution that's going to happen here is going to be slow at the beginning, but I think it's going to be similar to the adaptation of the alternatives into portfolios. If we go back about 22 years ago, around the turn of the last century, when that really began to accelerate across portfolios.
Yeah. And I think also that this is inevitable. And the sooner advisors get to that point, the better off they're going to be, because you can't abdicate. And we haven't even yet begun to talk about the new spot Bitcoin ETFs. But when they come to the market, we're going to have 12 big, huge financial service companies doing massive amounts of advertising for their products to gain market share. Your clients are going to hear these ads. They're going to see all of this, and they're going to be wanting to know, should I invest? How should I invest? Where should I invest? How much should I invest? And if the advisor isn't able to answer those questions effectively, they're going to lose credibility, and that is going to cost them clients and assets overall. So we need to get the passive engagers into the engagement camp. And in fact, that's our next slide. So let me jump right to that. So Matt, share with us, summarize for us what this slide is telling us.
Yeah. So this is really looking at, asking the question, so what are the products that actually your clients are really wanting? And you can see here that we've, again, split it into these segments, the current active engagers and the passive engagers. And I'll just hit on the highlights, which is when we look at these, particularly the actively engaged financial advisors, they typically are reporting that they're focusing on Bitcoin, on Ether, top 10 coins, and then some tokenized private equity and things like real estate offerings.
I think
when we look on the right-hand side, oh, can you guys hear me okay?
Did we lose me?
Yeah, I think we lost Rick. I'm going to plow on and he'll rejoin us, I'm sure.
Back.
Perfect. So yes, left-hand side was the actively engaged advisors. The right-hand side was the passive engagers. And I think the takeaway here is that they are generally preferring less volatile assets. So here we've got things like stable coins. This is the tokenized cash and cash-like tokens. And we've got things that are basically looking like securities, so tokenized listed securities. There is clearly less of an appetite for cryptocurrencies like Bitcoin, Ether. And so this is the difference between the active and the passive. The active says, I understand this market. I want to get into things that have some degree of volatility. That's part of my portfolio. The right-hand side tends to be less volatile. I think what's interesting is that the future intenders, we have additional data, but future intenders report that they are willing to focus more on the top 10 coins, excluding Bitcoin, Ether, along with stable coins. And that perhaps demonstrates a little bit their appetite to complement the digital asset portfolio of their clients who are already investing on their own. So Rick, to your point, we have some folks that, look, I didn't tell my advisor, but I've already got some holdings. But then when I go to my advisor, I want more diversity, more sophisticated, different sort of products. And I think we will see that coming more and more as we go forward.
I think you're right. And that is what the new Bitcoin ETFs are not going to solve, because that's just Bitcoin. I mean, how many advisors would give their clients an ETF that had only one stock in it? Not very likely. They believe, we as advisors, we believe in diversification. It's the foundation of our portfolio strategy. So Bitcoin ETF is fun, but it's just Bitcoin. So the fact that we have the opportunity as advisors to give our clients a greater diversification within the crypto space is really no different than giving the client the S&P 500. And I think that's really the crux of where you're coming from with Lionsoul, isn't it, Paul?
Absolutely. Yes. I think that it's about optionality. And, if you think about it, the traditional norms of investment management, diversification of risk across portfolios, like, focusing on, you have a beta return and you want to create alpha on top of that. So at least at first secure the beta return that you can actually deliver, and then we'll focus on where the alpha sources are. We also think the whole concept of yield is one that at times gets overlooked in this space. And I think this is going to be increasingly important now that, I've lived through, from the 80s to now, a number of different elements of the bond cycle, very high interest rates, dipping down to extremely low interest rates to virtually no interest rates, now back into sort of a more normalized pattern. So I think to compete in that space against bonds, like, yield is going to matter along the way as well. So I'm quite excited about the fact that the product array that will evolve in the next 5 to 10 years is going to look more like what we have in the past, which is why that advent of that ETF, if it all goes to plan, I think is a fantastic first step forward. But you're correct, we would never give up a single stock portfolio out or a single bond portfolio out, because you would just view that as an individual risk along the way. But that's where the traditional elements of asset management, the teachings of Fama, French, and all of these other great academics around that actually have created this industry that has served wealth clients and institutional clients well for many years. It's just going to begin to rhyme. And when it gets there, what you want to know is your custody works, your client reporting works, you're able to look at it online, that your client feels like it's a seamless experience, not that they have two sets of bulky reports, one coming out about your digital assets and then one coming out about your traditional assets. In the same way as you integrate today your alternative assets reporting into your clients' portfolios on a mark-to-market basis.
So Matt, let's recall again that we did this survey back in the summertime, and when we did it, the BlackRock application for an ETF was out there. Many other companies had submitted their applications, but it was still very early. We still weren't really sure how it was going to evolve. The Grayscale lawsuit had not yet been decided by the court, which ultimately favored Grayscale, and the SEC lost. And we've had a further big run up in crypto prices as a result of that since the time everybody filled out this survey. So given that, two questions for you. Given where we are today compared to last summer with the development of the spot Bitcoin ETF and the simultaneous thawing of the crypto winter, what do you think those two developments have done to affect the appetite for advisors, not just to engage, but to engage beyond Bitcoin?
Yeah. No, great questions, and very, very pertinent, as you say, with the recent thawing of the overall kind of crypto winter. I think when we look at that BlackRock spot Bitcoin ETF, it was filed, I think, June 15th with the SEC. So a little bit before this survey, a little bit ahead of it. And what we've seen in the broader crypto market is that as the discussion about potential approval has evolved, we've definitely seen more and more anticipation, and frankly, more and more people coming into the market saying, okay, if this happens and if it moves the market, I want to be there at ground zero. I think what's interesting there is, and it shows on this slide, that when we asked the financial advisors about their favored investment vehicles, clearly this ETF vehicle stands out, with more than 50% of the active engagers stating that they plan to offer ETFs with exposure to digital assets. So it's almost like a momentum swell, I think is what I described since the survey. But you asked the second question, which I think kind of gets a little bit more looking to the future, which is also, how do we expect the broader market moves, this thawing, to affect the appetite? And look, I've been around in this industry for actually more than a decade now, so I've seen multiple cycles come and go on this. And what we see each time is that the initial interest and the run-up of the market tends to be money moving, investing into Bitcoin is kind of like the initial magnet. And what happens is those capital inflows go towards the magnet, but after a while, the interest switches and it goes out to alternatives. So Bitcoin would still stay buoyant, but then, in the 2017 cycle, I think we saw Ether kind of picking up some steam. Subsequently, if you look at the last cycle, 2021, it was really focused on DeFi, and latterly things like NFTs. There was a lot of people saying, I get into this because of Bitcoin, but now I learn about a lot more, and I will diversify. And I would say this cycle could also be, a similar pattern that flows into Bitcoin and spot ETFs, but then potentially the diversification into projects like DePIN, if you know, decentralized physical infrastructure networks, is an emerging space where essentially it's bringing this idea of Web3 to all of the infrastructure that supports it, and allowing people to fully decentralize and invest in ecosystems that are doing that. So my sense is I fully expect the interest to be in Bitcoin, but actually that will then lead to subsequent waves of interest in increasingly esoteric and complex and sophisticated products. And I think that gets reflected in the financial advisor market too. You'll see more and more, as Paul said, of things like yield products and arbitrage and quant products following on the heels of some fairly basic tracker and passive products.
Yeah, I think you're absolutely right about that. I think there's a huge level of excitement, legitimately so, about the Bitcoin ETF, and it's going to generate a huge amount of interest and engagement by advisors. After they've done that, they're going to step back and realize all they did was give their clients Bitcoin, right, and that there's so much more to crypto than just that. And they'll be seeking alternative products to go deeper and broader into the space. So Bitcoin, the Bitcoin ETF is going to be a great entree and a way for people to begin their journey down that rabbit hole, but they're not going to stop there. And that'll be to the benefit of investors who should be more diversified, especially in a volatile asset class like crypto. And Paul, I think that the protocol and the platform that you are building at Lionsoul is really where the advisors are going to be headed, to that kind of a platform for exactly that reason, no?
Yes, well, we certainly hope so. And just to be very clear, this is a platform that is built by from an instinct of what advisors will be looking for. So it's you want security of tenure of the asset, confidence in that. So you've got to have your the custodians, and there are different ways to custody assets obviously in the digital space. My argument will be that yes, there are different today, but I would not rule out the possibility that the large blockbuster firms just eventually there's a consolidation process where they all fall in under the same name or the same brand. It's at some point along the way. So custodying assets, reporting on the assets. Importantly, from the advisor's perspective, how do you capture the existing assets that are outside of your current portfolio remit? How do you bring them in and ensure that you're making informed portfolio decisions around that? So helping to do all of those, creating those tools, creating secure wallets so that when they actually invest with you, they can actually access their in a very live fashion. So we've actually have a bespoke app that's available as everybody does today, but we have one that's available and can be tailored to individual needs around large networks where they want to have their own methodology of reporting. So all of these are what we're thinking about. The product construction process is exactly as you've laid it out, Rick. It's like there's the taster products, the entry products, and then it's broadening out to the wider universe, but avoiding they should have names that resonate with the traditional products that we see today, whether the equivalent of a value buy and hold strategy, the equivalent of a dividend yield strategy. We should see the equivalent of a growth strategy built in there, and then multiple cap layers on that, so all of that will be built in around the product array. And I do believe that this tokenization and the increase in tokenization, while it's starting to, in the last 3 years, as that, if we take that 5 years from now, there's going to be an exponential growth in the optionality that's out there from a tokenization perspective. And indeed, we may there may be a time at which you have mutual funds or 40 Act funds, and you have a tokenized version of those coming, and that obviously we'll talk a little bit later on about regulatory environment and such, but this is all in our view coming, and we want to be prepared for it and help advisors be prepared to react to that in a manner that they're comfortable with.
And in fact, let's launch right into that next slide. To your point exactly, what is it that financial advisors say they want from products? So Matt, tell us what we're looking at here.
Yeah, so we actually gave the respondents a long list of potential choices, and what you're seeing on the page are really the top 4 things that the financial advisors really care about. And a few things in this stands out to me. One is that this easy account enrollment and onboarding, especially amongst current engagers, is top of the list for a lot of people. That makes a ton of sense, right? We need to make the user experience good. We need to make it easy. We don't want to add to the burden of what advisors already have to do. And that's clearly going to be a key feature for anybody entering the space. I think similarly, secondly, we saw this piece around the importance of integration with existing workflows and existing tools. And you can see this is true for pretty much all the respondents. So those top two things, they just feel like table stakes. If you're going to do a good job, if you're going to get some traction in the space, make it easy, make it possible to integrate with already the systems they've already got. I think two other things stand out. One is this demand for flexibility of product vehicles. I think this actually is reflecting a variable level of sophistication amongst investors, variable demands, a range of different levels of what their expectations are going to be from this emerging asset class. And then similarly, the availability of a broad product universe and set of investment strategies, especially among those who are not actively engaging today. In other words, how do you make this option as attractive as possible? How do you put out there products and services that, frankly, will become the norm over time? But as this asset class begins to emerge, it will become initially difficult to find. It will become more and more common as we go forward.
So, is there anybody doing a great job at all these things right now so far?
To be honest, I'm not sure they are. I'm going to qualify it by saying that this is a difficult bit of code to crack, and I think we are very early in the emergence of this.
And I think that's exactly right. I think that most in the crypto community don't understand what matters to advisors. They're sitting there bragging about horsepower, and the advisor says, "I want a cup holder." And so I think, Paul, that opens the market wide up for Lionsoul because nobody else seems to get it yet.
Yeah, I totally agree, Rick. I think actually, we even in the traditional asset management business, people make the mistake of thinking you create this shiny new product that a portfolio manager says looks like one people love this, and then you go to market and you find that you're not raising assets for it. The reality of it is this is a demand-led business. So you have got to think about those who control demand, and that in the advisor market is obviously a lot of the in the United States, of course, the independent broker dealers, RIA, the fastest growing area there in the US as well. If you're not reacting to that and thinking about how you make this a seamless addition to their portfolio, that they're advising their clients on. You are exactly as others have said. I don't think that the industry is doing a good job. I think the industry is busy in science projects. Well, you got to be in. I don't know what the equivalent word for it is, but you've got to be in the hardware store before you get into the sweet shop, because you've got to make sure that it works. That that you've got the engine working well, and you're focused on the delivery. Then after that, the product itself follows, right. And it resonates, sorry, Rick, but it resonates in my view with what we're seeing in the traditional space today is there's going to be overlap. Just the alpha engine underneath it is going to just be slightly more tweaked.
And I think you're right. And the fact that you're focusing on this, and I know some others are as well, means that it's going to be a much better environment for advisors in the future. And that takes us to our final slide. What are the barriers? What is preventing advisors from engaging in digital assets at this point? So, Matt, tell us what we're looking at.
Yeah, so we asked again a laundry list of what potential barriers and some free text as well. First of all, when we asked engagers, what they mentioned is 4 key barriers to adoption. One is just the lack of a product's track record. I mean, this is totally to be understood. This is an industry not only that's relatively, or an asset class that's relatively new, but of course, has been littered with a bunch of challenges and stories that we could, we don't need to rehash, but we could. I think just insufficient and performance and tax reporting capabilities. This reporting piece that is so essential to doing this in a kind of in a grown up and a recognizable way tends to be absent. I think difficulties explaining the role of a digital asset product in the overall asset allocation process. Again, we don't have a lot of good precedents out there. We don't have good models to explain how to do this. And then finally, some security concerns of the asset issue themselves, or at least concerns about its operations. And I think just to be clear what's on the page, I think the advisors specifically also mentioned 4 barriers, and that they don't know how to buy digital assets. They don't trust the companies. Paul, this reflects what you said right at the beginning. They don't trust the companies offering the digital asset products. they don't necessarily think that these digital asset platforms are secure. And of course, they're worried about volatility as well. And so I think there is a real kind of solution set emerging from this that says, if you're going to be a service provider with a platform for digital assets and you're going to succeed, I think there's a few things that jump off the page, and I'll pause. One is that, look, you have to be good at providing education to your investors. Like, figure out how to make this simple, how to make it easily understood, how to understand the asset class a bit better. I think you need to demonstrate a degree of trustworthiness, right, in the company. And I would encourage everybody to go out there, do their own diligence on things like, compliance and custody, like really understand what these companies are offering. I think you have to allay cybersecurity concerns. And again, understand why this particular provider is able to do that. Be conscious about fees, and then ultimately there is you can see the bottom of the page, a concern about environmental impact. Again, that probably ties in with education, but just make sure that these things are being actively addressed, because these are truly the current barriers to entry.
Yeah, I think that it's going to become a self-correcting issue. I agree completely with advisors who are hesitant to engage in crypto because they don't know if they should trust these crypto platforms. These are new companies. You don't really know who they are, what their backgrounds are. You're not really sure what their financial stability is. You're not really sure what their expertise is, if they really understand the advisory community, let alone the investor mentality. And it's understandable that, do I really want to place my hard-fought client assets with someone who's been in business like a couple of years?
Yeah.
But that's evolving, because we are now getting huge companies from Wall Street engaged in the space, companies with decades of experience, trillions of dollars in assets under management, executives with an entire career in the space. Paul, what a poster boy for this. So I think that this is going to really create an ability for advisors to gain more comfort that, although the volatility of crypto and the uncertainty of that as an investment remains, at least the platform isn't a question. Just like if I'm going to buy a stock, I don't worry about the brokerage firm I buy the stock from. I focus on the volatility of the stock. And that's where we need to get with Bitcoin and digital assets. And Paul, am I crazy, or is?
Oh no, you're right on the money. This is a people business still, and it's about it is about trust. Fundamentally, you got to believe that the partner that you're choosing isn't going to let you down, isn't going to embarrass you, isn't going to result in you getting less fee income because of their actions. It's like when we thought about the North American market and the approach to it. We were very, very conscious of the individuals that we would bring on board at Lionsoul. So obviously we got John Cooper, who ran the intermediary business with me at Morgan Stanley, has joined me to actually lead on that. John comes from deep DNA in the industry, understanding how advisors think, and has spent his entire career reacting to that in blockbuster houses along the way. And I think that's bringing that DNA internally to this. That in part is the uniqueness of what we're doing. We're taking that traditional experience, bringing it into an asset management house and saying, doesn't mind, to all the kids sitting on the bean bags in the room, and we're sitting on the chairs, we're saying, you got to do it this way, because this is the way the individuals who are advising these assets will want to actually see them presented. And this is the way they'll want to be confident of the security of them. And I think that's just very important. It's a beautiful dynamic between that sort of barbell approach of the relationship alpha kind of thought process and this sort of dynamism that's there about developing what is a fast moving and exciting space. But one putting a slight brake on the other is actually not a bad thing actually to do, to create that sort of conservative dynamic to it as well. So that's that advisors can trust.
We only have a couple of minutes left. We've had a bunch of questions, and the most common one, a lot of repetition. Brandon and Matthew and others have asked this question. So I want to summarize the variety of ways this question has been asked. And I want each of you to weigh in on this, because it is about the elephant in the room, the Bitcoin ETF that everybody is anxiously and hopefully waiting to see. A couple of quick questions. I want you to give me speed answers on this. Will the SEC say yes to these products? What do you think it will do to the price of Bitcoin? We have seen predictions from Guggenheim and ARK, Bank of America, Standard Chartered, you name it, Tiburon, all saying anywhere that Bitcoin's going to go to 150,000, it's going to go up to $1 million. What do you think is going to happen to the price of Bitcoin over time? Do you think these Bitcoin ETFs are going to come to market? And will it be something that only benefits the price of Bitcoin, or will it be a rising tide environment that benefits all of digital assets? Matt, you go first.
Yeah. So look, I've learned not to try and speculate on what the regulator's going to do. What I would say is they've been very clear in their concerns about fraud and price and market manipulation. And I think the industry needs to prove that those concerns can be allayed if this is going to get approved. What's it going to do to the price? Well, look, I think there is an expectation it's going to go up going forwards. Of course, it does depend on the liquidity and how much new Bitcoin is made available and where these are going to be sourced from. I would also caution a little bit around, buy the rumor and sell the news. I mean, we've seen the market move already just on the rumor, and it's moved 20%. And so, I look forward to seeing what the impact could be.
Paul?
Yep, and my view, well, we have Chris Giancarlo as one of our senior advisors, the ex-CFTC chap. Our view on this today is that it's a yes to these being approved, but not all. And I think it's going to be, I think there's a very judicious approach from the regulator to actually bring forward, that start building trust around it. You have a choice in crypto, and it was just articulated in the European Union this week by by one of the ministers there. They said you can actually take a look at digital and you can ignore it, or you can try and stop it, or you can regulate it. And just said, well, you can't ignore it, you can't stop it, you got to regulate it. So I think that's where we're going to at this stage on it. And as to price on it, I'm looking forward to the day when it's not a price effect when these things happen. And I have no clue as to what that would do, because that my job has always been to work with the advisors to try and help them get great product into portfolios. But I do think we're at a very exciting phase with this. And I think actually the advent of, I think it will be a catalyst, whatever about the Bitcoin price, it certainly will be a catalyst for attention on the industry. And I do agree, it will lift the wider interest, and by default, I think you're going to see it moving out, spreading out in the digital space in terms of the market effect.
That's Paul Price of Lionsoul Global, and thank you for joining us, Paul, and Matt Higginson of McKinsey and Company. I appreciate both of you sharing this information, and thank you for joining us on this event too. Be sure to join us for our next seminar, our webinar online, Is the Crypto Winter Over? That's going to be just in a couple of weeks on December 13th with both GlobalX and CoinDesk joining us for that. So be sure to register for that event and get 1 CE credit. And mark your calendar and join us in West Palm Beach, Florida, March 10th and 11th. First ever brand new conference that we're creating called the Wealth Management Convergence. This event is specifically designed for advisors who want to focus on the key strategies that matter today. This is not a crypto conference. This is a broad-based financial planning and investment management event. And it's going to be really terrific. You can learn more about it with that QR code. And we really encourage you to come to our big crypto event, the 6th annual DAC FP Vision event, which will be June 2 to 4 in Austin. This is a 2.5-day event devoted to crypto, giving you the latest content on what is going on in the crypto space, the investment opportunities, practice management with leading thought leaders, and actionable ideas. And if you really want to get a deep dive so that you're proficient and fluent in this subject, I encourage you to get your CBDA, become certified in blockchain and digital assets. This is listed on FINRA's database of professional designations. You get up to 18 CE credits. The first half of the course is all about the technology, so you understand what it is, but the second half is all about practice management, the investment thesis, how to discuss it with clients, crypto taxation, compliance, operations, regulation. We've got 37 countries represented. Thousands of advisors from all over the world have obtained their CBDA designation already. I invite you to do the same. 5 different tracks, whether you're an advisor, back office financial professional, if you're in the crypto field, or if you're even an investor or student and merely the crypto curious. And because we've got students all over the world, the program is available now in 9 different languages. So I encourage you to check that out. And please read my new book, the #1 Amazon bestseller, The Truth About Crypto, which was named one of the best in business on the book awards last year. And to understand what's happening with the new spot Bitcoin ETFs, I've written a white paper. You can download it for free. That helps you understand what is going on right now in the spot Bitcoin ETF environment so that you can talk about these ETFs confidently with your clients. The white paper is free. You can download it and read it today. And be sure to tune into my daily podcast, which covers crypto and all the other subjects that matter to investors and advisors: longevity, retirement security, health and wellness, exponential technologies, and of course, blockchain and digital assets. And if you want to reach me, easy to do that. Lots of different ways. Happy to answer your questions, including those we weren't able to tackle due to the limited time on today's webinar. Happy to interact with you as well. Again, Matt, thank you so much. Paul, appreciate your being with us here today. Enjoy the holiday season. We look forward to seeing you again before too long. Thanks, everybody.
Thank you, Rick.
Cheers, Rick.